Hello and welcome. This is going to be a short video tutorial going over problem S16-5. So let's just jump on into it. I've got the problem ready for us here in Excel. So let me just read the problem aloud and then let's jump on through the solution. So what do we have? We have S16-5. At what amount should the following investment portfolio be reported on the December 31st year-end balance sheet? All the investments are less than 5% of the investee's shares. Prepare one adjusting journal entry for the portfolio rather than making separate journal entries. Okay, so we have to make a journal entry, so I should just have a journal entry template ready to go for us. So allow me a moment just to do this, and I spelled debit incorrectly. That's my bad. Let me fix that. Debit, credit, there we go. So I've got a journal entry template ready to go for us here, and let's look at the problem. So ultimately, we need to decide at what value should these investments be reported at the year-end on the year-end balance sheet. So a couple of things that jumped out at me. The first one is that these shares, all of the investments are less than 5% of the investee's shares. So the investor has invested in less than 5% of another company for all three of these. So less than 5%, less than 5% of all seasons, and I just put greater than, so I'm not with it right now. Less than 5% of all seasons, less than 5% of tent manufacturing, and less than 5% of East End grocers. So this organization has invested in less than 5% of all three of these organizations. Since they've invested less than 5%, that means that they do not exert significant influence over the other organization. So that impacts the way which we're going to value these. That means we do not use the equity method of valuation. So since we do not exert significant influence, or this organization does not exert significant influence, that means we do not use the equity method of valuation. Additionally, we're given a fair value or the market value. Since there is a market value readily available, we're actually going to use the fair value method of valuing these shares, which means that at the reporting date, we're going to value them at their current fair value. Now, the carrying value is the current amount on the balance sheet. Now we can see that just looking at these, the current amount on the balance sheet, the carrying value, does not equal the fair value. So we're going to have to adjust the carrying value to match the fair value at the year-end reporting date. That's the fair value valuation method of accounting for investments. So what do we need to do? Well, the carrying value for All Seasons Hotel, just looking at this, is 88. It's now 97. So it's actually appreciated by, what is that, $9,000. Tent manufacturing, our carrying value is 140, which is greater than, I can't get my greater than less than sign straight today, which is greater than the actual fair value of 124. So here there's what's called an unrealized loss, and I believe that is 16,000. And East End grocers, it looks like the carrying value is less than the fair value, so it's appreciated in total by $2,000. So overall, this question told us to do just one adjusting journal entry. So the adjusting journal entry is going to actually be the sum of the difference, all of these differences. So we've got 11,000. We've got overall between all three of these shares, there is a negative $5,000 difference between what the carrying value is and what the market value is. So we need to lower our balance sheet by $5,000 overall to get these to match. Since we haven't sold these yet, this is going to be what's called an unrealized loss. So I'm going to debit an unrealized loss account on December 31st, I don't know what year it was. On unrealized loss on fair value adjustment, 5,000. That's my debit. My credit is to this fair value valuation allowance. Now, this fair value valuation allowance, when it has a credit balance, it acts as a contra account to the actual investment. So right now, there would be a cost associated with the balance sheet for each of these as an asset. This fair value valuation would act as a contra account to offset it so that its carrying value would now match that market value. Okay, so this is how we would do problem S16-5. If you have any questions, please feel free to reach out. Otherwise, I hope you have a great rest of your day. All right, thank you so much. Take care.